Hello and welcome to Trading 5 Talents. Today's video, I want to go over the final results for the 532 Iron Condor strategy that I introduced last week. As a brief recap, the 532 Iron Condor strategy is set up like this, in which this is a traditional Iron Condor with the short strikes, which would be the short put, the short call, have a 5 delta each. And so with a 5 delta on the call side, for example, that gives this particular call a 95% chance of profit, and then the long call would be 3 strikes further out of the money. So that's the 5 delta, 3 strikes out of the money, and these are all 2 days until expiration. So that's where I'm getting the name 532. So with the short call, 95% chance of profit. That means there's roughly a 5% chance of it being in the money or losing in this particular scenario. So that's the 5 delta. And then on the put side, same thing, 5 delta, 95% chance of profit, 5% chance of being in the money. So really, this has a 90% chance of success because it's, again, the price has to be in between the short put and the short call of an Iron Condor in order for it to be profitable. But there's a 5% risk on either side of the Condor. So that means it's 100% minus the 5% minus the 5% gives you that 90% chance of profit that this Condor would be successful. So this is the 532 Iron Condor setup that I was testing. All right, so here's the candlestick chart for the Qs during my testing period. And I did the Qs because I was testing this Iron Condor iteration at the same time I was testing the previous one, which was on the SPY, and I didn't want to get confused. So that's why I chose this ticker, because it also has expirations every 2 days. Now, what I've noticed, though, is that there really isn't a difference in the premiums when I do this strategy, either on the SPY or on the triple Qs. So just because I'm doing it on the Qs doesn't mean that you can't do it on the SPY, and I would actually prefer to do it on the SPY. It seems like there's maybe a little bit less movement. So here are the 10 different trades that I made. Now, again, the color of the box represents a win if it's green or red if it is a loser. As you can see, there are no losers in this testing period. There is one caveat that I'll mention as we get there, but also for this rectangular box denoting each trade, I am entering approximately 2:30, for example, 2:30 p.m. on Monday, so about an hour and a half before the market close on Monday for expiration on Wednesday. Then I'll enter about 2:30 p.m. Eastern on Wednesday for expiration on Friday, and then the same thing for Friday to Monday. I just chose the 2:30 arbitrarily. I don't know if I thought it would be a better entry time, but that's what I did. So I tried to make everything as consistent as possible. Of course, you can trade how you see fit. The left-hand side of the box right here, this left-hand side, is when I entered. The upper is my short call strike. The lower bound of the box is my short put strike. And then the right side of the box is the expiration. So ideally, as long as the price stays and expires within the box parameters, then it should be a winner. So you can see in this first trade, usually when you enter, there's more protection down on the put side. It did gap down actually, but it expired within the box. This one was a winner. And here I entered this Iron Condor, again, more protection on the put side, and then it closed a little bit higher, but still well within profit range. For this third one, entered, again, more protection down on the put side. It gapped up, and then it gapped down, and then started continuing back up. It got pretty close to this short call strike, but still expired out of the money, and it was a winner. Here we have the fourth, gap down. Again, this profit range is so wide that you could have these dramatic gaps and these dramatic moves down or up, and you're still going to win. So here's one over the weekend. These shorter boxes are over the weekend. So like this one right here, this one right here. You can see there wasn't much movement. Again, it was a winner. This next one is a winner. This is the one that I should have lost, but I didn't, and I'll tell you why. So what I did is I entered this Iron Condor a day later. So this is Wednesday's, over here is Wednesday. And then there was I think it was a CPI report or FOMC minute release or Fed speak, something like that. Some big binary event. I didn't really want to enter a trade right after it because I knew, it would rebound or something odd might happen. So I just waited a day. I waited till the next morning. So this was entering on a Thursday, I believe. And this was that Thursday Friday period where we had that historic reversal in the markets. It was down like 2.5%, and then it closed up around 2.5%. So I entered Thursday. I'm not exactly sure what time, but I entered Thursday morning, and it just kept going up. So within the first day, it actually touched my short strike. But I couldn't exit because otherwise that would have been a day trade, and I didn't have any in order to exit. So I had to let it go. And I did let it go. And you can see it came back within this range, and it expired worthless, and I received the full profit. However, this one should have been a loser because it touched the short call strike. All right, the next, so Friday to Monday, good. Monday to Wednesday, good. And then Wednesday to the next Friday was also good. So all of them are winners. In reality, they're all winners, but I was expected to have this one loss. All right, so let's take a look at the actual data and the numbers, and we'll see what what I'm actually winning on these trades. All right, here's the 532 Iron Condor strategy data sheet that I made. And my expected win rate is 90%. And if I am winning these at approximately $16.20, and then a short touch loss would be $107.80, then I expected to win $162 for this testing period with 90% win rate. Okay, so these max profits are the average of my premiums that I'm receiving when I sell them. So for example, $21, $14, $14, $14, $16, $20, $15, $16, $15, and $17. So average it all out, it would be $16.20. Now what I'm actually getting is shown here in green when the exit actually occurred. That's what I'm expected to win on average, $16.20. I'm expected to lose about $107.80. Now, how I get that is on the short touch loss. So I use option strat. I think I already showed you how I set that up in the last video. Basically, I plug in all of the strike values. So not only the strike price, but also the premium that I either paid for it or received from it. And then I am able to look at the table to see at the exact time that I open up the trade, if the price went up to my short strike, whether it's the short call or the short put, I take the greater loss of the two, and that is my short touch loss. So in this case, it was $120, $110, $105. So whatever the greater loss is at the time of entry, that's what I enter here, average them all out, $107.80. If you look at that table, you'll notice that the values go down over time because of theta decay. So that's why I think the greatest loss, at least if all things are equal, the greatest loss is going to be at the time of entry. So taken together with those numbers, I was expected to win $162. What did I actually win? I actually won $146. So it was slightly less because really this one should have been a loss. This is the one that actually had the short touch strike. All right. So my 10 trades, the one here in blue is the one that I entered a day later. And you can see that here after CPI data. So I entered it just a day later. The upper strike was touched, and I didn't have a day trade to close that particular trade. So that should have been a loss, but it actually turned into a winner. Whereas this one, where I only won $1 from it, I was expected to win 14, but it got closed early because my put vertical was automatically closed by Robinhood at 13 cents because it was getting close to that put vertical. It didn't touch it, but it was getting close. You know, that's another thing that you need to consider when you let these spreads and, condors or spreads go to expiration. If you're using Robinhood, there is a chance that it could be auto closed if one of those spreads is at risk for being assigned on expiration day. And so it will auto close at 3 p.m. You just have to be aware of that. So overall, though, I think this strategy did really, really well, much better than the last strategy. And I was pretty confident when I introduced it that this would do well just because it has a 5 delta. So 90% chance of profit, 3 strike width. So you're going to need $300 in this case for every Iron Condor. 2 days until expiration, and based on the max profit average and the short touch loss average, this is a 7-to-1 risk reward. So you're going to risk 7 for every $1 in terms of reward. So is that good? Probably not. And I'm actually looking at a different strategy, a different iteration of the Iron Condor strategy to make that a little bit more favorable. But yeah, one loss is going to wipe out, 7 wins, 6 wins. So that's not ideal. That's why I'm going to still test some more strategies. But overall, this was a really good strategy. So I think I'm getting closer to something more ideal, at least for my trading style. Now, I wanted to show you this as well. This is the strike range. Look how wide these strikes are. It goes anywhere from 23 all the way up to 29 strikes wide. That is a huge profit range for this Iron Condor strategy. I think in the previous iteration, it was like 4, 5, 6 strikes wide. Now we're getting up to 29 strikes wide. That's really good. So that's why you're going to have a lot of winners, because of your 5 deltas. There's just a high chance of profit for this strategy. So would I recommend this strategy? Yeah, I think I would recommend it. I just want to make sure that you're aware of these different caveats. For example, the auto close by Robinhood of verticals that are going to be possibly assigned, and then also the risk reward is not that great, so it still needs to be tweaked. But I did want to go over these testing results and share with you to see if this is something that you like, and then also maybe it's something that at least gives you a springboard to continue on and developing your own strategy. So let me go over to the conclusions, and then I will wrap this one up. The overall conclusion of this 532 strategy is that it works great. There's a wide profit range, as you saw, 23 to 29 strikes wide, very high chance of profit, which results in consistent winners, which is good for trading psychology. So you see all these base hits. That's great. You're not just waiting for that one home run in order to save your portfolio. But you must watch out for that short strike touch. And also, I should have put in here, but you also need to be aware of the auto close feature on Robinhood. Again, that's at 3 p.m. Eastern, or at least an hour before close on expiration day, if one of your sides of your Iron Condor, one of your verticals, is threatened to be assigned. So you'd want to avoid binary events. You can see that I did, and it didn't really work out well. You can either avoid them completely by not trading when those are happening, or you can just reduce the amount of contracts or Iron Condors that you're trading and sort of reduce risk that way. But that's something that you do want to watch out for. So like I said, because of the risk reward strategy, I'm trying something different, and I'd like to see if I can't make that more favorable while still maintaining the same amount of wins as well as premiums. I'm not sure if it's possible, but that's something I'm testing out. So please be sure to subscribe so you can get the update when that is posted. And also, if you have any questions about this, then go ahead and leave a comment down below or catch me on Twitter at Trading 5 Talents. Until next time, trade wisely and take care.